everyone, welcome back to my YouTube channel. This is Maheshwari MR. I am the student of Sri Venkateshwara College of Engineering affiliated to VTU, approved by AICT, recognized by UGC under section 2F and 12B from the Department of Master of Business Administration. Today's the subject is financial management. In that we are going to discuss on the topic of debentures. First, let you know the introduction of debentures. Debentures are a type of debt instrument used by companies to raise capital. They are essential long-term loans taken out by a company or a government, which are typically issued with a fixed interest rate and repayment schedule. Here, and this debenture, fixed income. Debenture usually offer a fixed interest rate, meaning that investor receives regular interest payments over the life of the debentures. Unsecured. Unlike bonds, which may be backed to specify assets, debentures are typically unsecured, meaning they are not backed by collateral. This can make them riskier for investors compared to a secured debt instruments. In this debentures, when we came to this repayment, the principal amount of the debenture is repaid at the end of the term, which can range from a few years to several decades. And then tradability. Debentures can often be traded on financial markets, providing liquidity to investors who might want to sell before maturity. Purpose. Companies use debentures to raise funds for various purposes such as expansion of business, working capital, or restructuring existing. Advantages for issuers. Capital raising. Debentures provide a means for companies to raise capital without diluting ownership or control, as issuing debentures does not involve giving away equity. Fixed interest cost. The interest payment on debentures are fixed, making financial planning easier. Companies can budget for regular interest payments, knowing they won't vary with market conditions. And then disadvantages for issuers. Investor costs. Even though interest payments are fixed, they cannot relatively high compared to other form of financing, especially for unsecured debentures. This could strain for a company's finances if revenue does not meet expectations. And then debt burden. Issuing debentures adds to the company overall debt burden, which can affect its credit rating and increase borrowing costs in the future. And then the advantages for investors. Fixed income. Investors receive regular interest payment, providing a steady stream of income, which can be particularly appealing for those seeking predictable returns. Lower risk compared to equity. Debentures typically have lower risk compared to equity investments, as they are prioritized over equity holders in the event of liquidation, though unsecured debentures are still lower in the hierarchy compared to secured debts. Disadvantages for investors. Credit risk. If the issuing company faces financial difficulties, there is a risk that it might default on interest payment or the principal repayment, especially if the debenture is unsecured. Inflation risk. Fixed interest payments might lose purchasing power over time due to inflation, which can the real value of the income received from debentures. As you all gotten a better information about this topic, thank you for watching this video till end. Thank you.